Okay, what's going on, everyone? This is going to be the second half of the Chapter 3 videos. We have three more problems to do. So they're giving us some information here. We have a company. It's preparing its annual report, right? So we're going to be looking at kind of theoretically it's 10K. The controller has asked for your help in determining how to best disclose information about the following items. So we're really focusing on disclosures here. They're giving us a list of items, and hey, we can either disclose these things in A, the summary of significant accounting policies, right? So that's going to be A. What do we do in there? We kind of talk about the rules and processes, the procedures for accounting that we use. Hey, we follow GAAP. Here are our methods that we use to calculate depreciation. Here are we use LIFO for inventory, right? So it's just those accounting policies, right? So that would be one option in A. In B, it's just kind of a separate note, right? A note freestanding on itself. Or C, right? Do we have to put these on the actual financial statements themselves? Right, so there we go. Summary, note, financial statements, right? That's what we're like looking at these. So let's kind of check these out, right? The first one, related party transaction, that one is going to be B, right? That would be its own freestanding note. We care about this because you can manipulate the numbers if there's too many related party transactions. So a reasonable third party investor would want to know about that. How about the depreciation methods, right? This is going to be in the summary of significant accounting policies, right? So that would be A on there. How about the allowance for uncollectible accounts, right? That's going to be C on the actual financial statements themselves, right? You'd see that kind of, net of or shown with that accounts receivable. It tells us how much, we don't think we'll collect on those. Composition of investments for 4, right? This is going to be B. It would be kind of its own freestanding note on there. How about 5? Composition of long-term debt. Similarly, its own freestanding note. How about inventory costing methods? Yeah, that's going to be summary of significant accounting policies. We use FIFO. We use LIFO on there. How about 7, the number of shares authorized, issued, and outstanding? Typically, you would see this on the actual financial statements themselves. And then 8, employee benefit plans. That's going to be its own freestanding note. So just kind of being aware of some of those items on there. Okay. The next one, we have a little bit of matching that we have to do. Okay. So they're giving us what? Let's see here, 14 things that we have to match. Let's check these out. We will start with, and let me zoom in here. All right, the first one is the balance sheet, right? This one is going to be D, right? An organized array of our assets, liabilities, and equity. That makes sense. How about 2, liquidity, right? That one is going to be H, right? The ability of the company to convert its assets to cash and to pay its current obligations, right? Liquidity means how quickly, right, we can turn something into cash. How about 3, current assets? This one is going to be B, right? Items expected to be converted to cash or consumed within 1 year or the operating cycle, whatever is longer, right? So we have that kind of test that we looked at. 4, right? The operating cycle. This one is going to be J, right? This is that kind of cash to cash period, right? When and how long does it take from when you spend your first dollar to you get your first dollar? Different companies have different operating cycles. It could be a day, it could be a month, it could be a year, your operating cycle. Every company is different. 5, current liabilities, right? This one is going to be A, right? Generally will be satisfied through use of current assets. 6, cash equivalent. We're looking at K on this one. That would be an example of like a 1-month T-bill, right? We look at that original maturity of 90 days or less. How about 7, right? Intangible asset. This one is going to be M on there. We have lacks physical substance, right? Intangible is of the mind. Working capital for 8, this will be L, right? Our current assets minus our current liabilities. It's kind of a liquidity measure. Accrued liabilities, right? This will be G, right? Recorded when an expense is incurred but not yet paid, right? So it might be something like, here we are at the end of the period, right? We do the AJE, debit, salary, expense, credit, salary payable, right? That would be an example of it. We've accrued the expense up here, but we're only going to pay it perhaps next period. How about 10, summary of significant accounting policies? We just looked at that. That's going to be E over here. Important to a user in comparing financial information across companies. So that'll tell you, right, some of the accounting rules they've used. Subsequent events, right? This will be I, right? These occur after fiscal year end, but before the financial statements are issued. Again, something a reasonable third-party investor would want to know about. How about 12, sustainability disclosures? That will be N, right? Basically ESG, right? Environmental, social, and governance items. These are increasingly becoming a bigger deal in accounting. 13 and 14, right? Unqualified opinion. This is going to be C, right? The statements, the financial statements are presented fairly in conformity with GAAP. Whereas a qualified opinion, right, would be F, right? Like you fail, a scope limitation or a departure from GAAP, right? These are like kind of different opinions that you can give in the auditor's report. Okay, let's move to this guy, right? Last question. Nothing too bad here. Can you please determine the current ratio, the acid test ratio, the debt to equity ratio, and the times interest earned ratio, right? So we're looking at 2 liquidity ratios, more of a short-term focus, and 2 solvency ratios, more of a long-term focus. Short-term, long-term, each of them are going to have their own items. They're giving us a balance sheet, income statement, nothing too bad, right? So let's start with 1, right? The current ratio. We know, right, this is our current assets divided by our current liabilities, okay? So if we go over here and we look at these, right, we'll make our current assets green, or I'm sorry, yellow, and we'll make our current liabilities blue, okay? So up here, right, cash obviously is going to count. Short-term investments is going to count. The accounts receivable are going to count, and the inventory is going to count. PP&E is a long-term investment, right? So all of these guys are going to be our current assets, right? So let's sum those over here, right? So it equals what? 200 plus 150 plus 200 plus what? 350, right? 2, 150, 2, 350. Okay, good. That's great. There we go. How about our current liabilities, right? So, oh, that's easy, right? They just give us this right down there, 400. Not going to be too hard on there. So if we do 900 divided by 400, hey, our current ratio should be 2.25. Yeah, we have a lot more assets, almost like double, a little bit more than double actually, than our current liabilities. That's great. Let's then look at the acid test ratio, sometimes known as the quick ratio. What is this, right? Well, this is a little bit more refined, right? We're going to be more stringent on these current assets. We don't look at all of them. We basically narrow it down to just those ones we have control over, right? So that we can really in a GM, like, immediately get or liquefy on there. So that'll be our cash plus our short-term investments plus our accounts receivable over our current liabilities. And let me just center this. Oh, of course that screws this up. Okay, no big deal. And I'll center these two. Okay, so here, right, we can just pluck it from over there. Cash is 200, right? Our short-term investments are 150. Our accounts receivable are 200. That's great, 550. We know our current liabilities from last time, that hasn't changed, 400. Accordingly, right, the numerator divided by the denominator, right, we are looking at 1.375 for the acid test ratio. Whether that's good or bad, I don't know. Part of what I'd have to see is what other companies have for that. Okay? All right, next up, right, we have our debt to equity ratio. Pretty straightforward here, right? It's going to be your total debt over your total equity in that case. So in this way, right, when we look at our kind of debt, right, it will be, right, the current liabilities and the long-term liabilities, right, those two items. So it will be the 400 plus the 350. And then our equity down here, right, the APIC and the retained earnings, right, that will equal 750 plus 400. Okay, nothing too bad on that one, right? So we'll do 750 divided by 1150. We are looking at rounded, oh geez, and then let me shorten this guy, 0.65 for our debt to equity ratio. One more to go here, right? We'll do it down here, right? We need to do our times interest earned ratio. This has essentially our net income, right, plus our interest expense, plus our income taxes. So it's kind of like a form of EBITDA, right? It's like our earnings before we add back our interest and taxes. So it's like a version of that all over our interest expense. So this is going to be just plug and chug, right? We can grab the net income from down here. There's the income tax expense and the interest expense. So those are kind of our three items for it. So at the top, right, it will essentially be 160 of net income. We'll add back, right, because previously when we determined and arrived at that net income, we subtracted these items. So to kind of undo it, we have to add them back. The interest expense of 40, the income tax expense of 100. We're getting it 300 there, all over our interest expense of 40, right? That will get us our times interest earned outcome there, namely 7.5 times. Okay? That's just some of the equations, right? Like I said, with the equations, things to be aware of, or what I would just say at a high level, right? You need to know what we're getting at with the ratio. So like when I ask you what is the current ratio, right, you might say or should say, hey, that is a liquidity ratio. I'm looking to see how much we can pay and how quickly we can pay off our current liabilities with our current assets, right? So you need to know what it's getting at on there. You need to know the actual formula, right, on there. So it could be as simple as just plugging it in on there. The other thing I could ask, you about this is, well, in light of, okay, that's the easy stuff, but what would happen if, we bought more current assets or we reduced our current liabilities? In other words, if we do A, B, and C, how would this affect the ratio, right? In that way, right, we talked a little bit about this in the lecture. I just memorize it like this. I draw kind of like a big arrow, right? If the numerator goes up or the denominator goes down, right, the overall ratio goes up on there. So if it does it kind of, individually, you'd have to look at the cross effect of it if things happen on both sides of the equation. But that's kind of a simple thing. And then if you have the reverse, right, if you memorize this, then the reverse is the opposite, right? So if it's up, down, right, it's down, up, and then it's the opposite, right? It goes down. Sometimes accounting students are like, I need to memorize everything, right? I want to know everything. That's great. You can do that, but there's only kind of so much space in your head. If we know one thing, right, and the opposite has to be true, then just memorize that one thing. And if the opposite happens, do the opposite, right? Like George Costanza. So with that, right, nothing too bad here. We will finish up the problems at this point, and we'll kind of button things up then for chapter 3.